As the market is down at amazing lows, it's one of the best times to update our research and be finding the best gems that are undervalued. Today, we have Jonathan DeCarteret, CEO of Bumper Protocol, joining us, and I asked him to come on as this is one I have followed since before its launch. Its use case is something I believe will change taking profit strategies as well as passive income strategies for big funds, and also downside protection for many investors. With the recent problems of Three Arrows Capital and then Celsius and Voyager, we see how critical downside protection can be. Welcome to the Crypto Rain channel. I'm your host, Jay Rain. And if you like money in crypto and you're looking for a real investor take on the crypto market, join the Rainmaker family. You can do that as easily as liking the video and subscribing with the all notifications button. Now, I'm not a financial advisor. I'm a crypto investor myself, sharing with you how I think about the crypto market and specific cryptos I like. Do note, I own or plan to own most of what I talk about on this channel. Special shout out to our Patreon members. We do have a private Discord there. Patreon gets access to. Now, make it rain on that like button. Strap in for the show. Let's welcome Jonathan DeCarteret. Jonathan, thank you so much for joining us.
Hey, buddy. Good to see you again. Good to be back on your show.
Yeah, I'm really excited. Now, been a while since we last did our interview. And, I'm an investor. I like to buy things when they're undervalued. And, the Bumper token price has been really attractive. A lot of the audience members know what Bumper is, but for those that are hearing about Bumper for the first time, could you share with people what Bumper is and a few ways that it can be used?
Yeah, sure. Okay. So I think when you kind of consider financial markets, including kind of cryptocurrency markets, the biggest fundamental problem is volatility. It is the one of the most difficult and painful kind of issues that any trader can kind of encounter. And so what Bumper does is it provides this novel, innovative new approach on how to deal with the volatility problem. And fundamentally, what it does is it allows users to take their asset, which is going to be ETH at our launch, and you can set a floor price of your ETH token that you don't want your ETH token to fall below. And for that privilege or that service, you pay a daily floating premium. But essentially, what that gives you is not only the protection, so you have that peace of mind that you can go to sleep at night not worrying too much about your kind of portfolio, but it also allows it facilitates the exchange of some very interesting instruments. And what I mean by that is that what the Bumper protocol does when you take protection is it returns back to you Bumper ETH. So you now hold a very special version of ETH that will never fall below the price that you've protected, but will follow the price of ETH all the way up. And there are some very interesting things you can do with a token that has the downside volatility removed. And I think perhaps we might kind of tackle some of those kind of exotic use cases later on.
Yeah. Now, how is this different than, say, insurance? Because as I've explained this to people before, they say, oh, it's like insurance. And I'm like, not really. It's not insurance. Sure, there's some properties that have some similarities. It's not insurance. But how would I explain that it's different than insurance?
Yeah, sure. Okay, let's get into it then. So when you look at the ways to protect yourself from volatility, there are basically two main instruments that you can use, right? The first one is a stop loss. The second is an options desk, which is very highly used in traditional finance. It's a major derivative in that sector. The insurance model is something we looked at when we were kind of trying to solve for this problem, and it just fundamentally insurance model doesn't work for market price drops. And an analogy that I kind of arrived at was, imagine you have 10,000 cars on a motorway. When you have a price drop, it's as if every car then collides with another car and makes a claim on their insurance policy. And if that happens, obviously the underwriter would be just knocked out, right? There's no way that they could kind of pay all those those costs out and still be solvent. So the insurance model for price drops doesn't work. So you're kind of left then, I guess, with the good old stop loss, which is something that I think every trader has kind of utilized at some point. There are some problems with the stop loss. I know we talked about this in your last show, which is essentially it is a circuit breaker. It is an instrument which, if the price falls below a predefined price point, you'll then trade it out to stablecoin or whatever you kind of feel is safer. The problem with that, of course, is that quite often the market will just kind of dip below your kind of stop loss position, wick you out of your position essentially, and then the market then pumps, and you're now not going to kind of ride that benefit because you're kind of cashed out. So it's a very arcane and kind of dumb instrument, trusted but dumb, and free. Let's kind of give it that it does have some kind of merit, but that we felt was not a satisfactory solution to the volatility problem. And so you kind of then walk into the world of traditional finance and how they deal with it. And so traditional finance use options desks, which again, were invented in 1973. So we're talking about technology that's nearly 50 years old. Nothing's come along since to kind of beat it. It's based upon a formula that won the Nobel Mathematics Prize called the Black-Scholes equation or formula, which allows you to kind of basically price the risk. And so what options desks do essentially is they will buy your risk. They will provide you with cover in a contract. They will say that at a set price, at a set date, they will redeem you. So the problem with that is you've kind of got a very fixed window and price that you have to kind of work to. And after that date, that's it, you're not protected. And the second thing is it's expensive, because what options desks are doing is they're just passing that risk on to other instruments and other products. So it's what they call they're basically hedging their delta. So they're just pushing the problem off their plate, and they're trying to find another asset that they can hedge that will potentially give them cover if the asset drops, which is just a really, it's a really simplistic and expensive solution to what is a very complex problem. And I think all of that led me and my kind of co-founder to really look at the market and to look at what was emerging in DeFi, and to kind of say, is there a better way of dealing with this volatility problem? And we think Bumper is it.
So, yeah, would you go a little bit more in depth? So 50 years ago, this technology like options changed finance because it's expensive. We see it as expensive now because now we know that there are other options. But at the time, it was like, oh, wow, this is amazing. It introduces some downside protection. It allows them to like hedge their position so they can take some of the upside without as much downside, or they can say, if they want it to go down, but they can take the other side of the trade too. So with the emergence of DeFi and smart contract capabilities came your idea to protect it in a different way. Do you feel like it's something you could explain of how Bumper works with, say, and ETH is the first product that you'll be, or the first, I'd say, I guess, chain that you'll be rolling this out on. Do you mind explaining how it works? Say we're talking about an ETH price, just for simplicity, of $10,000. The ETH goes up to $10,000 and somebody wants to take some downside protection. How would that work? And especially then, how would it work if, say, the price then dropped to 5,000?
Yeah, sure. Okay. So I think it's probably the best to start off by saying that the inner machinations of how Bumper work are highly complex. And I'll caveat that with some stats. When this protocol is launched on mainnet, it'll be one of the most complex protocols out there. We're talking over 8,000 lines of code and 120 smart contracts with some serious equations that really drive how it works. So when we're explaining this to VCs, and VCs are some of the smartest people in the we even had to dumb it down a little bit for them to kind of understand the concept, and then you can start to go on. So let me start with the concept. So you start with Bitcoin at $10,000. Excuse me. And your thesis as a trader is that the price of your ETH at $10,000, sorry, is going to reduce down. So at that point, you use Bumper to protect your ETH at, say, 95% floor value. So $9,500. You want to protect your ETH not going below that price point. So you simply would connect to the Bumper DApp. You kind of set that as your floor. You set how long you want to have that protection floor, and that's kind of it. You kind of hit confirm. There'll be a transaction. The protocol then kind of basically takes your ETH, and essentially what a simplified way of looking at this is, let's say the price of ETH goes up a little bit from 10,000 and increases up, and then it dips down. Okay, and so when it hits that 9,500, the protocol would swap you into stablecoin, and then the price goes down a bit more. It pops back up again above 9,500. You're now swapped back into Bitcoin to ETH. And so what that kind of very simple analogy does is it gives the kind of the golden perfect protection mechanism, because what you have there is a tool which protects you from the downside like a stop loss, but it also allows you to benefit from all the uplift. And so that kind of really simple analogy probably is the best explanation of how Bumper works. The reality is that simple analogy doesn't work, right? So we tested this in with kind of hourly, minute, second, and tick data, and the problem is slippage. The problem is that if ETH starts to oscillate around the 9,500 mark, and you're swapped in and out stablecoin back to ETH, stablecoin back to ETH, and each time you're not quite getting the price you want, each time you're incurring transaction fees and gas fees, then essentially you're going to start to eat into the asset that you're trying to protect, and you're going to wipe yourself out. So we realized at Bumper that really we knew we had the underlying concept, but we had to solve for the slippage problem. And I think that's really where our kind of chief architect and CTO, Sam Brooks, really kind of came in and said, no, you solve that problem. You solve the slippage problem within this paradigm, and we've solved volatility within crypto. And so it turns out the way to solve that problem, that slippage problem, is the protocol will have on one side lots of people who are taking ETH protection, and they're protecting different amounts of ETH. They are protecting different floors that they're choosing, and they're choosing different protection windows that they want to be protected for. And all of that is all added into one big pool. And then on the other side, there are people who are providing USDC into the protocol. And the reason why they're presenting USDC is that the protection takers with the ETH, the premium they pay, the fee that they pay is essentially being passed over to USDC providers to incentivize them. But essentially, this is where the crazy maths comes in, is what the protocol needs to do is it needs to keep these two pools in balance. It needs to keep the ETH and the USD in balance. And so where the price of ETH drops and it needs to essentially cash out more people to USDC, it will sell USDC, but on the aggregate. So it's not dealing with just one person USDC. It is dealing with maybe hundreds of thousands of people's positions, and just selling out enough ETH to kind of bring the protocol back into balance again.
Great explanation. So if it were to drop down to, say, you buy it at 10,000, it drops all the way to 5,000, it's all right because it's actually been converted over to stablecoin, so they can cash in back to the value they protected at the 9,500 at any time. Should ETH take off and go to 100,000, well, then they get to explore that entire upside, which is amazing, right? Yeah. And on the other side of the equation is people that are trying to earn a yield with stable coins in a way that's sustainable, right? We've seen with the crash of Celsius and Voyager that what they were paying out, there's a lot of users that didn't realize the risk of, well, essentially they're turning around and lending that money out to someone else, and that's someone else trades it on leverage and gets liquidated. Well, then they can't pay it back, and it breaks the whole system, right? Which is exactly why Celsius and Voyager are, filing for bankruptcy and reorganization, because they've lent out their funds to someone else. though someone else lost them in leverage trades and can't pay them back. And so the risks were higher than realized by a lot of users. So what's interesting is that Bumper provides two sides, right? It gives those that just want to return on their stable coins a great arena to do that. And those that want to, like myself, explore further upside in a market that's going up, but you never know where the top is, options to protect for, well, maybe I stay in too long, and take the upside too long. Oh, shoot, you know what? The market has reversed. Well, good thing I'm protected. Now, Bumper's been hard at work getting the code written and then audited. And now you have a phased launch of Bumper coming up. Could you tell us more about the phased launch?
Yeah, sure. Can I just add a couple of
Sure.
comments to what you just said, actually, because you make some really good points there. So when you think about what Bumper does, then it does. So there's a few use cases in there, right? So there's that one that you mentioned, which is the market is pumping, and you're kind of thinking, if I protect the price as it goes up, then if it massively drops off again, well, then I'm going to profit from that kind of position that I've taken, right? Which is great. And Bumper works really well in that scenario. So if you say you take the floor, you protect the price here, some arbitrary number, $100, whatever it might be. And if the price goes up, $110, $120, $130, $140, then the price you pay to Bumper actually drastically reduces down. So it becomes almost nominal, your fees. So in that scenario, it would work really well. Like mathematically, Bumper is really well suited to that. It seems to me from what you were saying, though, with what we've seen with these kind of shockwaves within kind of the macro crypto picture, the 3 arrows, the Celsius, the Voyager, all kind of collapsing, is that the kind of main culprit here is leveraged positions that basically became liquidated and then kind of cascade down, right, and wipes everyone out. Now, the interesting thing about Bumper is, and this kind of goes back to the point I made before about bumpered assets, is let's just kind of see how crypto lending and leveraging works, right? So essentially, if you own, say, an ETH, and ETH is, let's say, $1,000 to make the maths easy, then if you want to borrow more ETH, then you have to deposit $150 worth of ETH in order to borrow another $100 worth of ETH. It's quite counterintuitive how that works, but essentially by doing that, you now have $250 worth of ETH. So you're now kind of leveraged up on ETH. Okay. And you can multiply that leverage. The problem is that if the price of ETH starts to drop down and it drops down below that 150% that you've kind of put down as your deposit is removed from you and it is liquidated. The key thing to understand about Bumper, and this is where no other protection mechanism even comes close to this, is that you will be returned back bumpered ETH. So if you've protected your floor at, say, $150 of your ETH, then your ETH will never go below that price. You will never be liquidated because the Bumper protocol will always redeem you at $150 because you're paying for that protection. And I think that there is a huge market for that, not just with retail investors and professional traders, but also with those institutional holders that have a fiduciary duty to take that kind of hedging position. So I think there's, now and again, a protocol comes out that can potentially bring about a paradigm shift. And, I'm quite a kind of realistic person, but I feel that Bumper could have that potential of offering a service which will make sure that in the future we don't see another reoccurrence of the 3 arrows and the Voyager and the Celsius, because there was a mechanism there that they could take to protect themselves. So,
yeah, it's fair to say this, if this rolls out, I can't see why this isn't a massive game changer. I remember before, in the early days when I had just seen Bumper's white paper and documents, I was reading through it and I was like, oh my gosh, sent it over to one of my friends who was huge into DeFi, and he read it and he's like, oh my gosh, this is amazing. If this works out like it is, this will revolutionize finance. And it's exciting what it can do because it's just a different paradigm shift of how to protect assets, right? So you have those that are trying to get a return on their stable coins. So they're providing the liquidity. You have those that have the assets, and either they're investors like me trying to explore further upside, or sometimes they're just long-term holders. But like you said, institutions have a fiduciary duty not to lose too much. So this gives them the ability to invest in crypto and have a downside protection that they'll love, right? So one of the reasons they don't get into crypto is because of the volatility, and that scares them. And so now they have the ability to protect it in ways that wouldn't have otherwise been available. And it can bring more institutions into crypto, because I think as they get this, they'll see, wow, this is world changing. So I think about it in a few different use cases. There's the one that I really like, which, so I've been in crypto for about 5 years, and I've seen like 2017 was really amazing. Early 2021 was pretty good. But one of the challenges you have as an investor is you like to buy low and then sell high. And as it's going high, sometimes I've sold too early. I remember one pump that was going amazing with the token that I had, and I sold it at 20x. I sold off a piece, and then I sold some more at 25x, and then at 30x. It went all the way to like 80x. So I was selling a bunch of it way too early. And the reason I had to do that is you don't really know where it's going to stop. And so you just have to sell it off in tiers as you're happy with different positions. What Bumper allows investors like me to do is, okay, so I'm pretty happy with some at a certain price. I can then protect the downside of it, but not sell it. And then if it goes way up from there, then I can rechange the position after a little while. Say at the 20x, I was pretty happy with that, and I protected it 95%. And then it goes up to like 40x. And I was like, wow, okay, well, let me just change term and protect it at this 40x price. And it would have allowed me to explore a lot further upside. And so that my average returns would have been a lot higher, right? Because I sold like 25% at 20x and then all the way up, and I missed the top entirely. Why? Because I had sold it all by then. So that's exciting to me, but I'm not the only one excited, because there's plenty of use case for institutions and others. Some that just want good, stable coin returns. And then there's the other side where there are institutions that have to protect their money, right? Or they're buying it for a long time, but they have to have some kind of hedge, because if it goes down a lot, then they could lose their role as managing these large funds. So this is going to be a very attractive product for them.
For sure.
Now, so where are we at? You do have the audit and review that just happened, and then you have a phased rollout coming up. Could you tell us more about what timelines look like?
Yeah, for sure. Yeah, like I said, this thing is insanely complex. So, you can imagine for us, we've been building for almost a year and a half with a very large engineering team, kind of just biting off bits of modules one by one and kind of getting that coded and tested. So we've gone through the first round of smart contract audit with a company we feel Sigma Prime are the best in class. So, they recently did Aubit's recent audit. And we've patched, I think it is like something like 99% of those potential attack vectors that were identified. So we're now moved on. This is only yesterday we moved on to alpha release. So this is where on a closed private net, a certain number of invited testers and individuals are now playing with the Bumper protocol. So this is this is like a huge moment for us and the team. We can now actually use the protocol. It's all on testnet, but it's using real price feeds. And we can start playing around with it, take protection, see what our yields are, see what our premiums are, close those positions, take that profit. It's really something to actually start to use this thing now, which has been conceptual for so long for us. So that alpha phase will carry on for a few weeks, and then once we've kind of updated any changes that come from that, we'll enter into a beta phase. So that beta testing is a much larger group that will be invited to test the product and to kind of identify any flaws or bugs or any additional features that they might want in there that aren't already in there. And I would encourage anyone in your community that's interested in becoming a beta tester to just reach out to Bumper on our website. And then once that is all completed, we will have the protocol retested by an auditor, because obviously all those little minor tweaks and changes we're making, want to make sure they don't open up new attack vectors. And then we will go mainnet. So we're looking to go mainnet. It should be in the next kind of 2-3 months.
Wow, that's all going to be coming pretty quickly here. This is exciting. Yeah, I've really been looking forward to this use case being rolled out for both sides, right? A lot of people are realized that like Voyager and some of those other concepts, you're not necessarily safe with your funds there. So they're looking for stable coin returns that are safe. At the same time, yeah, the downside protection insurance is really exciting. I mean, think about yeah, say this product had been out before and some of these positions had been able to protect themselves. We might even be in a different world right now from what we're experiencing. The only reason I think Bitcoin came down below 20,000 was the failure of these major institutions, right? And so I guess, and as an investor, I get excited when prices get really cheap, because a big part of the equation of doing well as an investor is buying low. And I still think crypto's future is amazing, that we're seeing this technology that will change the world. And specifically, your project addresses 50-year-old technology that was life-changing and world-changing 50 years ago, but hasn't been updated since then with a better way of doing it. And probably it wasn't even possible to do it until smart contracts. So really looking forward to
I think you make a good point there, because we're often asked by people who, haven't quite got under the white paper like you have, well, why hasn't Wall Street invented this already? That's a kind of common question that we get. And the answer to that is quite simple, really, is that you need the grid, you need an ecosystem that can support this protocol. And what I've learned about DeFi over the last kind of 2 or 3 years is that it supports this kind of thoroughfare of traffic, which has this property of really low latency, really high frequency, and those things put together create a kind of almost electrified liquidity, because the money is programmable, right? You can say to it, find me the best yield from whitelisted sites and park yourself there until the yield increases somewhere else, and then move there. So what that gives rise to is an ecosystem which can start to create instruments and products and structured products that you can't do in traditional finance, because you're talking about 1970s plumbing there, which is still in effect. And what we're witnessing clearly in DeFi is, okay, if we just throw out all that plumbing, we electrify the grid, we allow money to be trustless, permissionless, non-custodial, and programmable. And now what can it do? You start to see the emergence of things like Bumper, and also 1,000 other really interesting, exciting, innovative protocols that are emerging in DeFi and have done over the last couple of years.
Yeah, it really is the new phase of the internet, right? Web3, like just things that couldn't be done before without blockchain, without smart contracts. And it's really exciting. There's a lot of innovation that will be commonplace 10 years from now that hasn't been invented yet. And so really cutting edge place to be, exciting where it can go. Now, can you tell us, there is a token for Bumper. Can you tell us about the use case for the token, what it's used for?
Yeah, we spent a lot of time taking a very considered approach about how the Bump token would play a fundamental and central role in the protocol. This is not a token which is just a kind of add-on to how the protocol works in order to essentially have an ICO. The Bump token is multifaceted and has multi-utilitarian purposes within the protocol. So the most important is the utility which drives the network effect. Now, the key thing with Bumper is that when you take out protection, you are required as a user, as somebody who wants to protect their ETH, you're required to deposit, or what we call bond, a number of Bump tokens into the protocol. Now, you will receive those back when the protection policy ends. So you receive that back. But what that mechanism does is it ensures that all users of the Bumper protocol are contributing towards that network effect, and they're driving the demand on the Bump token. and demand should kind of result in an increased price if there's a relatively fixed circulating supply, which there is with Bumper. The Bump token also is used to, we talked before about trying to kind of balance these two pools of, say, ETH and USDC. And one of the key kind of tools that we have in our armory to try to drive in more USD depositors or more kind of ETH protection takers is we reward them with a bump distribution, a daily bump distribution. So if, for instance, we've got too many people who are trying to protect ETH and not enough people putting in USDC, two things will happen. One is the premium cost that USDC providers will receive will go up. So more people will flow in for that. And also the bump distribution that we share out will be pivoted more towards the USDC depositors because they're the ones that we're trying to attract into the protocol to bring it into balance. So, and then the final and probably one of the most important aspects of the bump token is the kind of governance purpose that it has, and allowing that community under the migration towards a DAO to essentially direct the future direction and purpose and add-ons and features that the protocol will have. So the bump token has multifaceted use, and I think all of those uses have all been very carefully architected in order to kind of drive people to acquire bump and to hold bump. And the thesis is, and again, like you said at the beginning, I'm not a financial advisor and I can't give financial advice, but the thesis purely theoretically should be that will drive the bump price significantly.
That makes sense. Totally. We are live. So if you in the audience have a question, I wanted to go live so that we could give you a chance to ask Jonathan anything while we're here. Just a few of the comments. Mark posted like 19 minutes before we kicked off. Looking forward to this interview. So yeah, I appreciate all you for joining us. Bill Gardner, Sailing on 2021, S3YU. Francisco Garcia. Yeah, any questions you have, feel free to chime in with your questions while we have Jonathan's time to get answers. One of the reasons I started a channel was that I didn't feel like enough people on YouTube did interviews with the project teams. And to me, the project team makes all the difference. The narrative or the idea is really important. But then you have to get a feel for it. Can that project team carry it out? Now, one of the things I liked about Bumper was you and your team. When we first spoke on a video call long before I think you covered it, I was just like, oh my gosh, this is amazing. And so then I invited you onto the channel. Could you tell the audience a little bit more about your background and also your co-founder's background?
Yeah, sure. Yeah, well, I've been running companies ever since I was 9 years old. So I've been kind of hustling ever since I was a kid. And I think I'm on business number 19 at the moment during that kind of career. Some notable wins, I started a company called Switch, which was the UK's 60th fastest growing company. And I kind of slowly moved across from a little bit what was termed then as the creative industries and media industry more into the fintech world, and then exclusively into crypto. Once I discovered crypto, that was it was a one-way street for me. And I've always been one of those entrepreneurs that runs businesses on my own. I like the dexterity and the quickness and the nimbleness that gives you. And I kind of feel that, where I've kind of had business partners or associates before, they just kind of slowed me down. The only exception to that is my current business partner and co-founder, which is Gareth Ward, who is someone that I probably spend more time with than I do with my wife. And is someone I felt is probably one of the most intelligent and hardworking and technically expert and creatively expert people I've ever had the pleasure of working with. And so what I realized in that relationship is that we could achieve much more than I could singly or he could singly. And we've attracted around us another couple of co-founders who have equal standing. One chap is Sam Brooks, who is our CTO. He's the chief architect and designer of Bumper. This is a guy with a cranium that is, exponentially large, and is able to. Well, he was responsible for the economic design for Haven, which was one of the world's first algorithmic stable coins back in 2017. So, to be the first person to kind of go, this is how they'll work, is quite, and it hasn't changed. I'm not saying it's a foolproof design as we've seen with Terra, but certainly someone who is on the edge of that kind of innovation envelope. And then an important part in any crypto business is the marketing aspect. We needed to raise a lot of money to build this. We need to attract a large number of mass market, institutional investors, retail investors to use the protocol. And so we're very fortunate to be joined by a chap called Jason Sutty, who was the founder of an award-winning marketing business called Copper. And so the four of us really kind of cover off all those kind of main bases that should drive a successful business. And it has been one of the most exciting and challenging processes to take a white paper and convert that into a fully functional working protocol that people can use and is ready to be published. And we are so close to that now that it's a real testament, I think, to all the hard work and brains in the room.
Fantastic. We have a really good question following up on that from Jester's Room. So this really expected to be driven by enterprises and not retail investors, he asks.
No, we don't see it that way. So it's a good question. So, and no one's done this before. So, we're kind of a little bit trusting our intuition. But our intuition is that the low-lying fruit, the early adopters, will be what we call kind of DeFi retail. So these are people who are comfortable using MetaMask. They've used kind of Compound or Aave. They've dabbled in different protocols. They know how it works. They're not going to be scared by connecting their MetaMask and, say, protecting their ETH. That we see as our bedrock. I think if we can kind of get that vertical market under our belt, those people using it to a point where they're making savings and profiting from that instrument, then very quickly we feel there'll be the professional traders that will come in there, the people who want to use that leveraged, bumpered assets to knock out any kind of liquidation risk. And once those guys come on board, then the institutions won't be far behind, because they're always seeing what professional traders are using and what instruments they should feel comfort around. Then the next kind of big move for us is what we call as the DeFi integration play, right? So what we want to do is to be able to kind of integrate into kind of the Bumper, into Compound, Aave, Maker, all those lending sites, and allow people just to click a button to saying, do you want to remove the liquidation risk and pay the fee to Bumper, right? And kind of click into that. And then we foresee there'll be lots of very interesting integrations, like a kind of Curve ETH Bumper pool, where you've got a kind of vault earning money, but it's protected by a certain floor that will never go below. There's one thing I've learned about DeFi is that people very quickly kind of look at what other people are doing, kind of go, that's a great idea, pull it over and plug it into their protocol, and then someone else takes those two and plugs it into something else. And so I think there'll be a very interesting era of kind of experimentation for that. But the kind of main, the end game for us is retail, crypto retail, right? So we want to be integrated into MetaMask, into Revolut, into Robinhood, where you could just hit a bumper button to protect your portfolio. That to be us would be, the perfect outcome.
So glad you asked that question, Jester, because it led to just really showing how big this can go. Like in anything, it has to start off small with people using it through MetaMask, and that's kind of a first stage as people get used to it, and as the algorithm continues to prove itself and that things are happening well, and people get familiar with it, and then it will continue to expand. We'll see, like, what I hope is we see what happened with like Aave. And I remember in the early days of Aave, it was called ETHLand, not Aave. And like, I remember an interview with them, and they were trying to explain this new concept, DeFi. And I just really didn't get it at first, because I hadn't ever seen something like that. what helped me with Bumper is I've traded options before, and I got options, and I could understand the difference with this. So I did kind of miss it on DeFi. I didn't invest in ETHLend. I didn't which then rebranded to Aave, and literally saw at one point over 1,000x. It was like, I think 2,000x. It was crazy. The returns as people started to understand what DeFi could do. And so, yeah, thanks for painting that vision of where Bumper would like to go. And if that happens, it'd be amazing. What is funny is we're in a down market right now. Views on YouTube videos and other things are down, but as we'll see as certain things pop off, like some of these interviews go back and get a whole lot of hits because it's generally slow. But then I think we just recorded our video that I do every week with my friend who's a price analysis expert for 30 years, not just crypto, but like every market. And he's pretty convinced that we're at or near the bottom, and that it's putting in a solid base, and that things are looking like they're really going to start climbing. We might have another drop, but then we're going to have this fantastic upside, which is the really exciting time to be here. But that time is only really exciting for those that are already here now, because when prices are inexpensive is when I like to stock up. And I did miss the floor. Like Bumper hit all the way down at 2.5 cents, and I didn't see it hit that. And I'm like, darn. So I did pick up a whole bunch more between 4 and 5 cents. Let's see some more great questions. From Hardcore, has Bump included ADA in their protocol yet?
Not yet. No, not yet. That's not something that we've kind of put in yet. I mean, obviously the roadmap for us really kind of consists of two expansions, right? So the roadmap is, what other assets can we add in that can be protected, and what other chains can we expand across? They're the main two kind of areas of expansion. And so when it comes to the asset classes to add into Bumper, we're really just going to work our way down the market cap, starting with the largest and going down, right? So after ETH, which is just it's a home swing because we're on the ETH chain. Obviously, Bitcoin, wrapped Bitcoin will be the next, and then we're going to work our way down. Obviously, removing stable coins, because obviously they don't need to be protected, or shouldn't need to be protected. And then we move on to the kind of the cross-chain thing. Now, the cross-chain play is important because, from our perspective, if we are not one of the first people to get across a chain, we'll just get vampire fanged attacked. Someone else will just copy the code, adapt it to that chain, whack it out, put a different token on it, and basically just kind of copy us. So it's important for us to kind of go cross-chain as quickly as possible. So we're working hard on kind of, we were talking to Ava Labs this week and Near Protocol. We'll be on BSC, which is obviously a very easy one to kind of port across to. Now, there are complications going cross-chain. We need to make sure that there is sufficient tooling on those chains. So the DEXs and a few of the other kind of instruments that the protocol needs to use on those chains. But essentially, the kind of the gambit for us, and this is by design, right? The protocol was designed this way, is that by getting our TVL as high as we can and getting the token price as high as we can, then by design, the protocol becomes more robust. It becomes more robust at protecting people, making sure that it weathers kind of black swan events, that it can kind of reliably pay out those premiums to USDC depositors. So the imperative on us is to expand as quickly as we can. This is a new way to protect asset classes. Like, we can fundamentally see that is now the case. We built the protocol, we see it working. The gambit for us now is, can we expand quickly to control that market and to build a walled garden around Bumper where it just becomes the de facto building block to protect yourself with, because it's the most robust one.
Yeah, I love the name that you gave it to, right? So when I was in business school, we talked about like why tissue paper is really called Kleenex by everyone, right? Because they were the first, and there's really not a name for what you're doing, right? There's no name for this type of protection. So it's like Bumper, if you think about it. Well, Bumper was a great name for it, because the whole idea might just get called Bumper. Will you bumper it, even if other competitors eventually come in? So as I was thinking about that, I was like, great name for the protocol and for what you're doing, right? Because it correlates. You answered a bunch of questions all in there, like what assets can be covered with this protocol. You kind of walk through that. So great question by Fantastico. And Zawin asks, essentially, you're on ETH now. What chains are coming later? Which you answered as well. Conrad asks a good question. And he says, hey, got here late, so we might have covered this. What would be the cost? And let's be fair, Bitcoin long-term will be way higher than 24,000 it's at now. Why use Bumper on it if I'm holding for 10 years?
Yeah, well, if that's your thesis, if that's the user's thesis that actually I want to just be a long-term hodler, then probably Bumper's not for you, right? If you're going to buy today and just sell in 10 years, the Bumper is not a protocol that's going to have any interest for you. I think where it may have interest is where, had one had the hindsight, the invincibility of hindsight, to Bumper Bitcoin when it was at 69,000. Okay, and then take that floor price, wait for it to drop, and then kind of redeem it, and let Bumper pay you back out $69,000 for your Bitcoin, and then you rebuy Bitcoin at 20,000. That's a clear play that this is designed for.
Yeah. For long-term holders of just hold it and forget it. Doesn't really have the use case for swing traders, though, that hold for periods of time. Bumper has an amazing use case. And even those that trade pretty regularly has use cases for them. If you're just going to hold for 10 years and you're buying fairly low, not a use case for that. Let's see. So Sailing on 2021 says, all exciting. Are there plans to be able to use it cross platforms? We kind of addressed that. Okay, and Aave, he says Aave is great. Perfect. Well, I'm really excited what this can do, and the team behind it and seeing it roll out. I'm especially excited because I was able to buy a whole bunch for cheap. I'll probably buy some more. It wicked up all of a sudden, right? So I saw it come up a little bit and I bought some. Then it wicked way up and I was like, whoa, stop going up. I like to buy cheap. And so it's come back down to around, it's just under 6 cents now.
I think I'll kind of
market cap is only 14.6 million, and that gets me excited when I don't know what the market cap itself is right now because I don't know how much in circulation, but that's a pretty good price on the fully diluted market cap, in my humble opinion.
Well, we probably expect that as we come to market through those stages of the alpha release, the beta release, the mainnet release, that should probably give the market more confidence about Bumper's efficacy, right? And that should be reflected in the token price.
It starts to come front of mind too, because one of the challenges we have in this space is you just get overloaded. You cannot keep track of everything. There's 20,000 altcoins out there, and even if there's like 100 you like, even trying to keep track of 100 is just an insurmountable task. So what happens is things come front of mind. Bumper is not hugely front of mind for a lot of people right now, which is reflected in the price, which is when I like to buy before it comes front of mind to everyone. And when it does come front of mind to everyone and I see the price pump on things, well, that's when I like to take some profits and sell. And, then maybe it kind of fades out for a little bit, gets cheap again. And, just that's how I play it in the crypto market. It seems to work pretty well. Well, great, Jonathan. Thank you so much for joining us. We really appreciate your time. To the audience members out there, I thank you for your great questions. One follow-up on Conrad, he got it after that. He's like, the volatility will always be in the markets, but how are you guys making bank if you, for example, paid out on the 69K to somebody when Bitcoin went down to 20K? I guess that gets back into how your mechanism works. He's still thinking like an insurance type product, right? But it is an insurance. So how does Bumper not lose money on that trade? Because, I guess you kind of went through this again. For those that are joining late, would you just take a second to explain how Bumper works around that so that you're not making a loss? In fact, nobody's really making a loss in that situation.
Yeah, I mean, the simple answer is that the person who protected Bitcoin at $69,000, as the price came through $69,000, the protocol would have cashed you out, swapped you to stablecoin at that point. So at that point, and it does that obviously by kind of balancing the two pools between the aggregate of Bitcoin in this example and USDC. Now there is, so as the price, so the protocol was able to pay that money out because at the point where it went through 69,000, it swapped you out to stablecoin, so you can redeem that whenever you want. The caveat on this is that as the price starts to drop more and more and more and more and more, and it goes down from 69 and 50, 40, so forth, that your premiums will start to increase. So you'll start to feel the pain of kind of retaining that protection. And that's for good reason. You know, at some point we need people to bank their profit, come out of the protocol, and not pay premiums anymore, basically. And so it's kind of close their position.
Yeah, because what he's referring to is like old technology, there really wasn't that option. So there's one of two options. You put in a stop loss. So when it hits 69,000, bam, you know, they're stop lossed out. And, you know, anyone who's traded with stop loss has been wicked out before. Like I remember I woke up one morning and my position should have been up by 2,000, which means I should have been up by about 12,000 because I was trading on leverage and I was all excited until I saw that I had been stopped out. And it wicked down just briefly below my stop loss point.
Yeah. And
so then I got none of the upside whatsoever. So what Bumper allows is you to not be stop lossed out so that you can further explore that upside. But should it reverse and go down, it almost then acts like an insurance, but it's not insurance, because in insurance, they would be incurring a huge loss there, right? Because they would have to make up that difference. And so it's like gives you the best of both worlds in a way that was never available before. Like this concept's new. So,
and the final thing I'd say is for your community, we have a raft of technical papers that go from the very kind of top overview to the very detailed. And if anyone wants to kind of really understand how this works, you know, I'd encourage them just to go to bumper.fi and take a look at our papers there.
Perfect. Yeah, website is bumper.fi, like bumper.finance. So thank you everyone for joining us. Jonathan, thank you for your time. The market is down. It's way down. And smart decisions made during this time when prices are at crazy lows lead to life-changing results. Remember, no rain, no gain. We've got a little song. This is a rap that I had written. I wrote the words on this. I'll give you the full song. It's about 2.5 minutes, but it really reinforces the principles that I teach about long-term investing. And these principles make a huge difference over time.
Came into the space chasing all of the gains, chasing the pumps and all of the hype trains. But like in life, shit right before you could. Was told to buy when it was pouring like a rainmaker should. I buy when it's down, don't chase the post that I miss. Cause I always make the time in mind. I stick the one out cause I'm patient like that. And I'll wait for the right time. I sell when it's high, I buy when it's low. They call me rich, they call me smart. I'm just a rainmaker running the show. Calculated investments, I don't leave with my heart. Principles are simple, they're leaving a mark. Why when it's boring, just gotta be smart. I sell when it's hype, like all the channels they pump it. That's when I was selling, got parabolic to dump it. They call me rich, they call me smart. I'm a rainmaker, making my own start. I'm with the future, learning the past. Makes it time fly by, years going so fast. The game plan is mine, I'll own it now. When I reach the top, haters asking me how. Cause I'm a rainmaker, investments I love. And I follow what I learn, not relying on luck. Time is never better, the time like the present. This next 5 years is a gift and it's feeling like heaven. I'm committed to learn, studying to know that nothing comes easy, but with knowledge the game show. Sticking out this wrong, cause soon will come a bear market. Learning and growing, and when it's slow will be the target. They say it's come out, Bitcoin is dead. The massive decreases can get to your head. Sticking around, the time is better. Strong like that, I'll let the others be fretters. 2 years time, the ball will bring back the gains. That makes it worth the effort, cause here comes the rain. So let's go rainmakers, let's make it all happen. Let go of the hate, let the haters be crapping. I'm here for 5 years, let's do this together. The time is right, the time could be better. They call me rich, they call me smart. I'm a rainmaker, making my own start. I'm with the future, learning the past. Makes it time fly by, years going so fast. This game plan is mine, I'll own it now. When I reach the top, haters asking me how. Cause I'm a rainmaker, investments I love, and I'll follow what I learn, not relying on luck. Haters be hating, but time to slow down. Addressing what they say when I'm wearing my crown. They're chasing green candles like someone who was new. I got a vision that was bigger, helping me to push through. I'm still human and sometimes it is rough, and that's what makes me special, simply I stay tough. Cause I'm a rainmaker, investments I love, and I follow what I learn, not relying on luck.